Hey guys, what is up? Welcome back to the channel. I hope you all are having an amazing day today. We have another big week of earnings coming up with some great companies. I am going to be going over each company that I am watching ahead of their reportings and the key things you should watch out for. Real quick, if you're new to the channel, subscribe maybe and give this video an early thumbs up as I would very much appreciate it. And remember, I am not a financial advisor and you know how that goes. So let's get started. The first company we're going over, as you can see, is PayPal. One of my favorite companies. They have been benefiting greatly from this pandemic as a lot of people are making digital payments, and their service has just become very convenient during this time, and overall it's convenient in my opinion. PayPal Holdings is scheduled to report third quarter 2020 results on November 2nd. For third quarter, PayPal expects revenues to reflect year-over-year improvement in the range of 23% at current spot rate and 25% at FX neutral basis. The Zacks consensus estimate for revenue is pegged at $5.4 billion, indicating an improvement of 23.4% from the prior year quarter. Notably, the company surpassed the Zacks consensus estimate in 3 of the trailing 4 quarters and missed the same ones. It has a trailing 4-quarter earnings surprise of 9.08% on average. Taking a look at Zacks EPS surprise chart, we can see PayPal has done a great job with their past earnings reports, as they only have one negative surprise. And actually, their largest positive surprise percentage was last quarter in Q2, up 27%. I believe, in my opinion, they could beat this percent this time around, considering the key factors we are going to go over right now. Most of the main components for PayPal's Q3 earnings will likely reflect off from PayPal in putting innovation and strengthening their services. The company made the PayPal Business Debit MasterCard available in 5 European countries, which include Ireland, Italy, Spain, Austria, and France in the soon-to-be reported quarter. This is likely to get reflected in the third quarter results. Further, the company's third quarter results are likely to reflect gains from the strength in product lines, including Venmo and One Touch. Moreover, Venmo and One Touch are expected to have contributed to growth in its net new active accounts. These two products are known for accelerating customer engagement on PayPal's platform, which is expected to have bolstered total active accounts in the to-be-reported quarter. Now, a big key factor for me that is highly convenient during this pandemic is the new QR code payment facility, which ensures touch-free payment service, is likely to have gained strong traction among customers during the coronavirus hit third quarter. And lastly, PayPal has seen huge growth with new users, as well as spending volume on normal days that rivals what the company was used to seeing only around big events like Black Friday. PayPal is betting that a wave of new features could keep customers even more engaged. These are a lot of great factors to look out for, and I believe you should definitely keep your eye on PayPal. They're doing huge things, and this company is just growing so much. Now, as for the analysts and what they are saying, they're estimating PayPal's earnings per share at 94 cents and estimated revenue of $5.43 billion. Next company that is reporting their earnings for the week of November 2nd is Square. Square Incorporated is scheduled to report Q3 earnings results after markets close for trading on November 5th, 2020. The company is expected to report earnings of 16 cents a share and the revenue forecast of $2.08 billion based on a poll of 27 analysts implies a year-over-year growth in revenue of 245.3%. And if we take a look at the EPS surprise chart on Zacks for Square stock, we can see Square has done very excellent as well, with a lot of positive reportings and only one negative surprise. If we take a look at how they did in Q2 of 2020 on August 4th, we can see they had an EPS surprise of 357%. That is absolutely insane. And in my opinion, I believe they can overcome this number because they have also benefited greatly during this pandemic. But that is just my opinion. However, this one analyst from Deutsche Bank, Brian Keane, anticipates another strong showing from the payments industry disruptor. We expect Square to continue executing with improving seller trends and Cash App strength, from stimulus and increased demand for the company's digital solutions, driving stronger long-term growth rates than before the pandemic. All in all, Keane reiterated a buy on Square shares, and with Cash App driving significant outperformance and the seller recovery looking more likely to become the next leg of growth, bumped the price target from $180 to $215. So what's in it for us investors? Upside of 26.5%. And speaking of Square's Cash App's gross profit surged 167% to $281 million. The company said that the app had over 30 million monthly transacting active customers and over 7 million spending on its cash card. Overall, Wall Street was happy to see Square customers using more of its banking features. The company's longer-term goal is to become the bank of the future, plus its seller business saw volumes return to growth in July, and its online gross payment volume jumped 50% to account account for 25% of seller volume in the second quarter. So definitely these are some factors to watch out for. I mean, Cash App has been killing it, and Cash App is used a lot by a lot of people. It's a very, very popular app, and it has been used so much, especially during this pandemic. Zacks estimate calls for Square's revenues to soar 70% in both Q3 and Q4, both of which would top last quarter's record growth. Despite its projected top-line expansion, Square's adjusted earnings are projected to fall by 44% and 13% respectively over this stretch. I am definitely going to be keeping an eye out on Square. I'm also thinking of buying before earnings because they are growing and are obviously so innovative and expanding their financial services that they offer. And I will say this, they do have more upside than PayPal. And that's because I'm a PayPal girl. I use PayPal a lot, literally for everything. So I'm very excited for Square and excited to see how they do in Q3. Third stock to watch out for, as you can see, is the Clorox company. Obviously, this company by far has done so well in this pandemic, with people going crazy for Clorox wipes and literally storming grocery stores for these wipes, especially at the height of the coronavirus pandemic back in March. The Clorox company is slated to report first quarter fiscal 2021 results on November 2nd before market open. In the last reported quarter, this Oakland, California-based manufacturer and marketer of consumer products delivered an earnings surprise of 20.5%. Moreover, it delivered an earnings surprise of 11.3% on average over the trailing 4 quarters. Now for the Zacks EPS surprise chart, we can see this really nice chart for Clorox, and it seems they have been on a streak with positive surprises starting from August 1st, 2019. Their last earnings, which was for Q4 of 2020, had a 20.50% positive surprise. Now, in my opinion, for Q1 2021, I do believe Clorox will outbeat this number with a really, really high percentage. In my opinion, because again, they have been on fire during this pandemic and people have been needing Clorox wipes just like they've been needing toilet paper. No, but on a serious note, this is a company you should watch ahead of earnings, no doubt. Key factors to consider for Clorox earnings. In the last reported quarter's earnings call, management predicted continued gains from persistent strong demand globally for cleaning and disinfecting products, aggressive investments in its global portfolio, and minimal disruptions in its extended supply chain and other operations. The company's top-line results for the fiscal first quarter are expected to reflect continued gains from volume growth and higher organic sales. Further gains from its cost containment efforts are likely to have aided margins and the bottom line. Further, it has been progressing well with its Ignite strategy, which focuses on maximizing opportunities in the core international business and increasing the demand for more sustainable products such as new Clorox compostable cleaning wipes. These are great factors listed, and I'm not too sure how Clorox will do in the long run in terms of high growth, but it is a pretty good value stock for the long term. But as of right now, they are doing extremely well, and who knows how long this pandemic is going to last. But however, I am going to be watching out for this stock. Now, as for the analysts, they are predicting an earnings estimate of $2.32, an estimated revenue of $1.76 billion. The fourth stock to watch ahead of earnings is Peloton. I've heard so much about this stock, and there has been a lot of hype surrounding it. This is another company that has benefited greatly during this pandemic, with people working out at home purchasing and using Peloton's products as gyms were closed. And also, not to mention, Peloton stock is up almost 300% year to date, which is huge. Peloton Interactive is slated to report its results for the first quarter of fiscal 2021, covering July through September 2020 after the market closed on Thursday, November 5th. Now, looking at the Zacks EPS surprise chart, we can see there isn't much history to look back on for past earnings because of the fact that this company went public last year, 2019, around September. And considering how well this stock is doing year to date and the sales from their fitness products during this pandemic, I can see Peloton doing even more well with a higher EPS surprise percentage. Now for some key factors to watch out for ahead of Peloton's earnings. Management guided for revenue of $720 million to $730 million, representing growth of 218% year over year at the midpoint. It didn't provide earnings guidance. For context, last quarter, Peloton's revenue skyrocketed 172% year over year to $607.1 million, speeding by the $566 million consensus estimate. Growth was driven by a 199% rise, or tripling, in connected fitness product revenue to $485.9 million, and a 99% increase, or doubling, in subscription revenue to $121.2 million. The number of connected fitness subscribers grew 113% year over year to 1.09 million. A second factor to watch out for is their Bike Plus sales. Investors will want to focus on early sales results for the company's new bike, Peloton Bike Plus. Sales of this upgraded model began on September 9th in the US, Canada, UK, and Germany. With the introduction of the new bike, priced at $2,495, Peloton dropped the price of its original bike from $2,245 to $1,895. At the same time, the company announced it was rolling out a new, less expensive treadmill, which will be available in late December in the UK and early next year in the US, Canada, and Germany. And a third factor to watch out for is supply-demand dynamics. Demand has been so strong that the company has been unable to churn out its exercise equipment fast enough to keep up. If this situation lasts too long, however, some potential buyers are likely to purchase equipment from another company. However, all in all, there is great opportunity in Peloton, which is why I'm looking to investing in this company. And speaking of the opportunity, Peloton's growing library of consumer data has the potential to generate other sources of revenue. And this is what the co-founder and CEO John Foley said on the most recent earnings call. You're absolutely right about the opportunity we see with corporates and insurers. We think that this is a massive opportunity and potentially a very big growth vector for us in the coming years. He's referring to health insurance providers using Peloton's user data to offer discounts to its policy holders. In other words, if I am a connected fitness subscriber and I work on my Peloton bike or tread a given number of times per month, the premium on my health insurance plan will be discounted. I'd assume a sizable chunk of members would choose to share their data if it meant lower insurance bills resulting from concerted efforts to improve health. And this sounds great, to be honest, in my opinion. This would be game-changing. However, there is some downside. Although Peloton may not do something like this for a long time, it does bring up another issue: data privacy. The company's main focus right now is to protect consumer data. Overall, there is massive upside in Peloton, and while doing some research on my own, I see massive growth, which again is why I'm looking to invest in this company. Now, for analysts on Peloton, they have an earnings estimate of 11 cents, an estimated revenue of $747.95 million. Peloton seems like a really great company, which is why you should watch them ahead of earnings. Well, that brings us towards the end of this video. I hope you all enjoyed this video as much as I did filming it for you all. These are all really great companies to watch ahead of earnings and really great factors within them. That being said, don't forget to like and subscribe for more videos just like this one. Also, don't forget to turn on those post notifications to be notified every time I post a new video. I appreciate you all and thank you for watching. Until next time, peace.